Imagine if your personal credit score was downgraded. How would that impact your day-to-day life? Now imagine that happening to an entire country. In today's video, we're diving deep into the recent U.S. credit downgrade from AAA to AA+ and drawing parallels between personal credit score. We'll explore the reasons behind the downgrade, its implications, and how it mirrors the struggles of maintaining a good personal credit score. All right, stay with us until the end to understand how these macroeconomic events can impact your personal finances and learn strategies to safeguard your financial health against such economic downturns. This is not just a lesson in economics, but a guide to navigating the complex world of personal finance in an ever-changing economic landscape. Let's unravel the complex world of finance in a way that hits home. Today, we're embarking on a unique journey, drawing parallels between the recent U.S. credit downgrade and your personal credit score. So hopefully that's intriguing. You should be. But before we dive into that, don't forget to hit the subscribe button and ring the bell to stay up to date on our latest financial explorations. So let's go ahead and get started. All right, picture this. You're a responsible borrower. You pay your bills on time. You're careful with your spending, and you've got a stellar credit score. But then life happens. You face unexpected expenses, your debt starts to pile up, and before you know it, your credit score takes a hit. Does that sound familiar? Now let's scale that up a few trillion times, and you've got the U.S. economy. Recently, the U.S. credit rating was downgraded from AAA to AA+ by Fitch, a credit rating agency. This is akin to your credit score dropping due to increased debt and financial irresponsibility. But what does this mean for the U.S. and how does it mirror our personal financial struggles? So let's break that down. All right, first of all, let's understand what a credit rating is. So just like your personal credit score, a country's credit rating measures its creditworthiness. It's an evaluation of the likelihood that the country will repay its debts. A downgrade like the one the U.S. just experienced is a big deal. It's like your credit score dropping. It makes borrowing more expensive, and it shakes investor confidence, and with lack of confidence creates volatility, and volatility creates instability, and that creates issues. Now, why did this downgrade happen? Fitch cited expected fiscal deterioration over the next 3 years, increasing U.S. debt, and repeated debt limit political standoffs. In similar terms, the U.S. has been spending more than it's earning and has been fighting over its debt limit. Sounds like it's maxing out your credit cards and arguing with your spouse over the bills, doesn't it? Not that that would ever happen in my house. Here's where things get interesting. The U.S. Treasury is selling about $870 billion of debt this year. That's almost $1 trillion. It's like you're taking out loans to pay off your existing loans. So just like your personal debt, the more the U.S. borrows, the more interest it has to pay. However, there's a twist. Some argue that this debt doesn't matter because we owe it to ourselves. It's like saying your credit card debt doesn't matter because you owe it to the bank. But we all know that's not how it works. The debt still needs to be paid and the interest keeps piling up. Much of the U.S. debt is in short-term T-bills, paying around 5.5% interest. If the U.S. sold all 10-year T-notes at 4%, they could save a bundle, but there might not be as many buyers. It's like trying to refinance your mortgage to a lower interest rate, but your credit score is too low to get approved. Put it all together and we see that interest rates are on the rise, not only in the U.S., but globally. However, the move down in U.S. inflation should theoretically cause rates to decline. It's like your credit card APR going up even though you've been making your payments on time. The big money doesn't trust the numbers. That's why we're starting to see interest rates. Typically, we would see interest rates drop with inflation dropping. The ETF for long-term T-bills, TLT, recently gapped lower and broke through a very important support level. That's a signal that investors are losing confidence, and just like lenders might hesitate to extend credit to you if your credit score drops, that's the same concept. Now let's talk about the debt ceiling. A few months ago, Congress suspended the debt ceiling because the government was about to run out of money. It's like you maxing out your credit card and asking the bank to increase your credit card limit. But just because the limit is increased doesn't mean the debt disappears. It needs to be paid back with interest. Congress authorizing additional spending is like you deciding to take on more debt. But where does that money come from? You guessed it, borrowing. The government borrows money by auctioning off treasury bonds, just like you might take out a personal loan to cover your expenses. In August alone, the government is looking to borrow $1 trillion. That's significantly more than ever before, excluding during the pandemic, of course. It's like you're taking out the biggest loan of your life, and it's not even to buy a house or a car. You're just taking out a loan to pay off other loans. So who buys these treasury bills? They're mostly scooped up by banks who really don't have a choice in the matter. It's like your bank offering you a loan because they know you're a good customer, even though they're aware of your increasing debt. So it's not a great situation. They're sort of being forced into purchasing this debt. But here's the crux of the issue. Do the banks use the money they have sitting in the RRP, or do they use their bank reserves? If they use the latter, we could see asset values come crumbling down. It's like choosing between using your savings or taking out another loan to pay off your debt. Either way, it's a risky move. As long as the administration continues to spend, eventually they'll have no choice but to use reserves. It's like you're spending without a plan to pay back. Eventually, you're going to run out of options. So what's the takeaway here? Just like your personal finance, it's crucial for a country to manage its debt responsibly. A credit downgrade, whether for a person or a country, is a wake-up call. It's a signal that it's time to reassess financial habits. Cut back on unnecessary spending and focus paying down debt. But remember, it's not all doom and gloom. Just like you can rebuild your credit score, a country can rebuild its credit rating. It takes time, discipline, and a solid plan, but it's definitely possible. And that's it for today on this financial voyage. We hope that you found a comparison between U.S. credit downgrade and personal credit scores enlightening. If you did, don't forget to give us a thumbs up and share it with your friends. Let's spread the financial literacy together. That is a guaranteed message. Before we sign off, remember, finance doesn't have to be complicated. My name is Darren Hunter. Have a great day.